Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options. All right, well, since we're about to start, I just wanted to check in and make sure that we're able to hear Toni. Toni, if you've called in, if you could just give us a heads up.
Yep, can you guys hear me okay? Testing, 1, 2, 3.
Yep, you sound great.
Okay, great.
Okay, great. So I think we have just one more minute, and then we'll kick things off. All right, it is 4:30 in New York, so we're going to kick things off. Welcome to this afternoon's webinar. Today's session will be hosted by Toni Hansen, who will be teaching us about high-probability swing trading strategies for ETFs. So for those of you who are new to our series, Toni is one of our webinar veterans. She's one of the most respected technical analysts and traders in the industry, with a high reputation for accuracy in both bull and bear markets. She began her trading career as an equity swing trader and has since expanded to many other sectors of the market. Her style of trading and market analysis transcends both time as well as market vehicles, making it attractive to investors and traders of stocks, futures, options, ETFs, and even the Forex market. So at this point in time, I'm going to go ahead and turn it over to you, Toni. Thanks.
All right, thank you. As she said, we're going to be dealing with high-probability swing trading strategies, and we're going to be focusing on ETFs today. Now, for those of you that don't know me very well, I actually got a start it's been about 14, 15 years ago in the markets, and one of the first things that I started trading was swing trading securities. So we're going back to my roots here with this class today, and we're going to talk about a couple of my favorite types of trading strategies where we're looking at multiple day holds. So when I'm looking for a swing trading strategy, basically I'm looking for a setup that is forming on the daily time frame to begin with. And then typically I'll drop down and I'll look at smaller intraday charts to kind of give me a little bit better clarification for timing the actual entry and the stop. And I'll also check them against the larger time frames, such as the weekly time frame, to make sure that I'm not going to be running into any resistance and that sort of thing. And we'll get into that in a little bit more detail. One of the first things that I was interested in when I got into swing trading was I was trying to find pullbacks in an uptrend, because this is, the core strategy that so many people are introduced to when you come into technical analysis and trading in general. And what I quickly discovered was that you can't simply buy any pullback into a support level like a moving average and expect it to work out favorably in your direction. There's a lot more to it than that. So we're going to look at some of the pros and cons that can help you narrow down positions, and how to use the ETFs in particular as swing trading vehicles. Now, for those of you that aren't familiar with terminology, an ETF is an exchange-traded fund, and they were introduced in the 1990s, about when I started trading. And they're a type of investment fund that typically tracks a particular index. They also have Forex ETFs, so you can track currency pairs and that sort of thing as well. One of the most popular, of course, people know a lot of are the QQQ, and also the spiders and the diamonds. So these are tracking the NASDAQ 100, the S&P 500, and of course the Dow Jones Industrial Average. But ETFs can track a lot of different indices, and there's really a plethora of ETFs these days. It's kind of I guess, ballooned over just the past 5 years even. It seems that there's always new ones coming on board. And they're a lot like mutual funds, but they trade like stocks on the major exchanges. So you can buy and sell them throughout the trading day, and you can also short them. So unlike mutual funds, which are basically purchased at the closing price of the day, you can treat them just as you would any other type of active trading vehicle. Now, in 2007, ISE announced a partnership with First Trust, and they launched a series of ETFs as well that were based on the ISE's indexes. So they're starting to gain a lot of popularity, and we'll see these throughout the course of today's presentation. Here's a couple of links on this slide if you want to learn a little bit more about them. And then as we look at what ISE has to offer for ETFs, these are the ones that are currently available. And the most liquid is FCG, which is the Revere Natural Gas Index Fund. And this is a particularly great ETF if you're a swing trader because it trades very smoothly on the daily charts. A lot of times, some of the ETFs are very thin, and you don't really have enough liquidity to be able to get into and out of them as easily as you would like. So you'll have more gaps overnight, you'll have choppier intraday action, and a wider difference when you're looking at the bid and ask prices on the ETF and the volume that's available at those bid and ask prices for getting into and out of a security. And that's one of the first things that you want to look at when you're looking at any ETF. ETFs in general are a lot easier for most people to swing trade than they are to day trade because so many of them do have the lighter volume. When you're looking at FCG, that's one you could actually day trade and you have a great liquidity in that intraday as well. But I generally prefer to stick to ETFs for swing trades. So when we're looking at some of these, a lot of the focus is going to be on that FCG here. And you'll see that a lot of the ones that they have to offer, though, are really great for swing trading aside from that one. Now, there's two core strategies that they stand out to me more than anything else, really, when I'm looking at swing trades. And they're just easy to recognize once you get the feel for what you're looking for. So it's very easy to pick out these two particular strategies that we're going to cover in today's session. And as we get into them, you'll see that there's a lot of core basic kind of building blocks for these techniques that you can really use and apply to any type of market that you're trading, whether you want to trade the swing trade, the ETFs, whether you want to trade options, or even intraday for scalping techniques. You can use the exact same strategies on a tick chart as you can use on the daily time frame. It's just that today's focus is going to be upon looking at these multiple day holds. Swing trading for me means that I'm holding it at a very minimum of 2.5 to 3 days. And a lot of times 3 to 5 days is usually my average, but some swing trades will actually last up to a couple of weeks. So when we have something that's setting up on, say, a daily time frame, you might also have a strategy that is setting up on a weekly time frame as well. So you can use that smaller daily chart as that swing trading entry, but then end up with something that you can hold for a couple of weeks for a major swing on the weekly time frame as well. And like I said earlier, it's really beneficial to use those multiple time frames if you can, because you're going to help narrow down and weed out some of the cons that you might not see if you're just focusing on one time frame alone. The two strategies that I use, I call them two-wave continuations and momentum reversals. So we're going to look at these one at a time. The first one is a two-wave continuation. And for those of you that have my five technical tools you cannot trade without DVD series, the bonus CD that's in that series actually focuses almost completely upon this strategy alone. It's about 3 hours, and it goes into how to trade without using any indicators. And this is the core strategy that is focused on in that course. And very, very simply put here, let me grab my pen. When we're looking at this two-wave pattern, we're looking at a continuation pattern that's typically forming within a larger trend. Now, sometimes it can be something that is reversing from a larger downtrend. So the continuation is actually a continuation of this first rally up off of lows. And then you get two waves of corrective action. So the two waves are referring to each of these pullbacks following that initial upside move. And some of the traits that you want to look for when you're looking for this strategy are where it takes place in the larger trend. So you're looking at trend development. Typically, the best strategies are going to be taking place when it's a newer trend. So something has been forming a longer downtrend for a while, and then you're getting a reversal and these two-wave moves on the upside where it's a new uptrend. The first couple of these are going to be the strongest of the two-wave buy strategies. Once you get past about 3 waves on the upside in a new trend, your risk is going to increase. Even when you get another continuation move, oftentimes it's going to have a slower follow-through. So if we look at this, I'm going to clear this here, and let's say we have 3 waves of upside, and each of these waves has a two-wave correction between it. Then typically, following that third move of upside, if it gets another two-wave correction, just say here's our 2 waves in each of these, then it's going to have a more difficult time following through as solidly as it did each of these previous moves to the upside. So it might still be able to manage a slightly higher high, but you're typically not going to get the same momentum as you did in that previous upside. Now, this is going to sound a lot like Elliott wave. Actually, when I came into trading, I didn't really know much about technical analysis in terms of like the technical terms people used. I sort of developed my own system because there wasn't a lot of books out there at the time. There weren't. When you're looking at trading, all of the trading books focused upon fundamental analysis as opposed to technical analysis. There was Murphy's technical analysis handbook, which I came across a few years later, that had actually been out at that time. But there wasn't much for actual courses or anything in terms of technical analysis because online trading was still pretty much in its infancy. But Elliott wave is something I read about a few years later after I'd already noticed that we were seeing these patterns of 3 waves on the upside and then a trend would often reverse. And this is in reference to Berger's question here. But the thing that I really have that's different from the core Elliott wave theory is that when you're looking at a trend move on the upside, it's not necessarily whether it's 3 waves or not that is going to make the biggest difference in terms of whether that trend reverses or not, but how long each of these corrective moves lasts. So let's say the first correction after a first wave of buying lasts for about 30 days. And then the second correction is also about 30 days. Then after that, if it tries another 30-day pullback, that's when you're going to see that that channel is going to break, that you're going to see an end of that trading channel. Even if it attempts to push higher one more time, it's not going to be able to manage that same move as we saw on that third wave higher. So it's the correction periods in between those waves of buying that really make the difference. A lot of times you'll see trend days where it just seems like it's going up and up and up all day. It's pulling back, heading higher, pulling back, heading higher, way more than 3 waves of buying on the upside. But the difference is that the corrective phases between each of those waves will typically not be comparable. So one might last 15 minutes, maybe another last 45 minutes, another last 30 minutes intraday, all the way up. And so then the three waves doesn't really hold as accurately. Another thing that really comes into play that's extremely important is momentum. So if momentum is shifting, you're going to have a reaction in terms of how that price moves. When we're looking at the two-wave correction, the really important momentum shift that you want to pay attention to is that second corrective move within this two-wave pattern. So you want a slower, more gradual move on that second pullback here than you see on the first pullback. So when that happens, you've got a shift in momentum that is going to allow for a more rapid break higher out of that second pullback than you saw heading into this overall congestive type of phase here. That same is true if you get a two-wave correction where the second wave is slightly lower than the first wave. It's another variation of the two-wave correction, two-wave pullback. You want to see this momentum shift as it's coming into this second low. And a lot of times it might actually start out more quickly, but then round off and slow. So it can drop, let me change the color here. It can drop more quickly and then sort of roll lower, and you'll get this more rounded type of bottom before it comes off of the low. When that happens, though, there's a higher chance that it's going to hold resistance at these previous highs following that, or that came before that first wave and that second wave of downside. So what can happen is it might stall here, or it can stall up here before it gets going again. And the two-wave correction can actually turn into more of a three-wave one where it will look like this. And then up. So the momentum into this second low is incredibly important in determining how quickly it's going to be able to break out of that congestion or that pullback. Some of the other traits that you want to look for on this two-wave pullback are going to be support levels. Now, major support levels are going to be things such as the 20-period moving average. Some securities will hold a 50-period moving average instead. Usually, when there's a little bit of a cushion under a moving average and it holds a low under that, the next time around you can put about the same amount of cushion underneath it to give it a little bit of that room to determine, well, where is it actually going to react the strongest to it, and where are you going to see that reversal from that second wave heading to the upside. This is the FCG, which I mentioned earlier as ISE's Revere Natural Gas ETF, and this had a very strong trend move on the upside last year and heading into this year, where we got a lot of these two-wave corrections taking place on the daily time frame. The first one here is not as clear-cut as the previous ones, and is actually part of this larger downtrend. So it's the upper channel here as part of a larger downtrend move. So the first chance you'll often see heading into these two waves as a continuation move, this pattern is one that I call a phoenix, because it's basically rising out of the ashes of a downtrend. And you'll usually see it happen looking like this. And it can often hug that upper channel for that larger pullback. So it's basically the first continuation move in a new trend on the upside. And that's the type of action that we had back here in September. So it's a little bit sloppier than a lot of the two-wave continuation patterns that you might see, but I wanted to go ahead and point it out here anyways, because the fact is a lot of them aren't going to look perfectly textbook. You're going to see a lot of variation, and it's very important that you start to recognize them. One of the things that I always do is that I like to make sure that I'm printing out examples of the trades, examples of the strategies, and keeping sort of a folder that's basically a trading journal that allows me to go back and compare the pros and cons on different strategies. One of the pros that is common when you're trading this two-wave pullback is that volume will drop off as that correction continues, particularly in that second phase or second wave of the correction, such as you would see in here. You might see a little bit of a volume spike coming into that first low, like we saw here. But then heading into the second low, the volume is going to be lighter than it was on that first low. So that can be very important. You want to see that lighter volume into the second low than you saw into the first low. And this will give you that added confirmation that even though it's pulling back, and even though you're continuing to see selling in the security, it's not a strong sell-off. There's not a lot of confirmation to the move, for example. So you'll see that slow down as that second one pulls back. And here's the shift in momentum as well. So this first drop here, we had a 2-bar pullback basically. Came up, put in a second little high there, so here's our 2 little highs. And then the overall trend shifted. So we had a slower pullback that lasted for 5 to 6 bars heading into that second low in October. And we saw the same sort of thing again in November, whereas a faster pullback into low number 1, but then a second slower pullback into the end of November. And when you're looking at the two-wave continuation, it's very important not only to identify 2 lows, but also 2 highs. And if you can't identify both of those lows and both of those highs, you've got a higher risk strategy on your hands. And it's going to have a more difficult time really getting going. You might even get a third low where you see a longer base, a longer correction before you see more clear-cut highs and lows before it can continue. What you'll notice here is that we do have that longer trend. But in terms of how long it took the corrections to develop, over time, notice the difference. Actually, let me draw them straight across from the time the correction began until it continues. That way you can see why it is that we have more than 3 waves of upside. So now that I've drawn these sideways, actually the last one I drew a little bit longer since it should correspond to that low, you can see that the amount of time that it took for each of these corrections to form varies. So this is where you have that difference from Elliott wave, because you have that continuation of the trend despite the fact that there's more than 3 waves of buying on this. This actually gains up in here before it starts to turn around into this year and had a larger correction. Here's another example. We're looking at FNI, which is I'm probably pronouncing this horribly incorrectly, but it's ISE Chinindia, and it's another ETF here. This is a little bit thinner than we saw in the previous one, but it still has the 2-wave corrections. Again, this is the first one coming out of a longer corrective phase. This is the 50-day moving average this time. So this ends up being sort of a resistance level as that new trend begins, and that's why it cuts across right through the middle of each of these 2 waves of pullback. Now, the second one here is a little bit of a better setup, because a lot of times what I like to see is on that second corrective move, the second wave, that it's at least as long as the first wave of correction. If it's not, this triangle, in some circumstances, can become higher risk, particularly if the trend is more developed on the upside. So if it's really extended on the upside and you've already had a number of waves of buying already in, if you see more of a triangle type of 2-wave continuation pattern at a high on a trend, there's a higher probability that it's going to fail. So the fact that this is taking place newly coming out of congestion is a pro for it, and it sort of negates that con that it would be if the trend were further developed. Over here, however, you now have the second move in this new uptrend. And so it's a lot because of that. We also have a very clear-cut change in momentum with a slower pullback. And if you had dropped down to an intraday time frame, like a 30-minute or a 60-minute, what you would have seen is that there would have also been a two-wave correction within the second correction here. So it would have looked like this on that intraday chart before it got going. And here's that bigger move. And so the two-wave correction here created that smaller little channel just lasting about 3 days into the very end of the month that could help you with timing a larger pattern. In this case, we had a gap triggered on the gap. So when a strategy is developing with a gap into the next morning, so you basically miss your entry trigger because it gapped higher the next day, usually what I will use is that first 5-minute bar the next morning. I'll wait for that to break higher. And once that breaks higher, I'll use that as my entry trigger. Here's another example looking at this on the weekly time frame. This is, again, FNI. And here were those two waves that we were just looking at. I'll clear this here. That first one and that second one. So this gave us a third push higher. The third push was actually stronger than the previous two, but the corrections were the same. So this first one and the second one here, the amount of time that it took for each of those correct was very comparable. So that's why it was able to just put in these 3 moves to the upside coming out of this congestion and didn't really keep going. This had that secondary two-wave correction. I'll clear this again. Here, where it had the first pullback into the 20-period moving average, and notice there was actually a two-wave pullback into that 20-period moving average, but the momentum of it overall was comparable to that previous upside, so it wasn't able to bounce really clearly off of that level. Instead, it hugged it and then led into a second wave of correction, which again had 2 corrective moves within it as well. So once again, if you dropped down to the 60-minute time frame, you'd have been able to identify the 2 waves of correction within that second correction on this larger time frame. Actually, you could drop down to the daily time frame to see that a little bit better. And so it hugged this more gradual pace or momentum into that 50-day, or 50-week rather, which was support in the past, and we had lighter volume into it as well. So that helped support the breakout here. So the momentum shift, we had the 2 and 2, very strong support levels, volume drop, and then the strong momentum move on the upside. Now, just to show you how this can really look on a lot of different types of securities, one of the sessions that I did just about a month or 2 ago for ISE, we were looking at options. We were looking at timing targets on the options, and one of the strategies that we were looking at was equal move. So basically, we were looking at an initial drop, and then the pattern itself, which in this case was that 2-wave move. And let me clear this and draw this a little bit better. So here's that 2-wave correction right here. First wave up, second wave is more gradual, and then the continuation. And that creates the target level here with that equal move to this first drop. But you can see that even with the options, you're looking at that same type of strategy, and it works really well no matter what asset class you're focusing on.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.